business people. You're watching Bloomberg Quint. We're in conversation with Dr. Rajiv Lall, CEO of IDFC Bank, and Mr. Vaidyanathan, founder and chairman of Capital First. The two announced a merger over the weekend. Gentlemen, before I say welcome and thank you for talking to us, I must say you spoiled everybody's weekend.
Not ours.
No, it was a fabulous weekend, but we had to work through it. But congratulations on the deal.
But we had a good weekend for the shareholders.
Yeah, of course. I'm talking about us poor lesser mortals who had to be busy writing copies. No, but on a serious note, thanks so much for speaking to us. Appreciate your time. Dr. Lall, I'm going to start with you. From the outside, it looks like a much neater deal than the Shriram transaction, from a shareholder perspective, fit of the two books. Plus, the management transition has been clearly laid out. And even, from a sort of cultural perspective, it just looks like a neater deal.
Even from the inside, it looks neater. Yeah. So both from the outside and the inside, okay. I can confirm, yeah. So it just, it's a much easier transaction because it involves only the bank and Capital First. The strategic synergies, I think, complementarities are very clear. Our stated goal has been aggressive retailization. This merger brings that and more. 3 million customers, brand footprint, retail asset book, with a focus on a particularly interesting customer base, which is harder for banks to access. That's another important feature of the strategic fit. Then from culturally, this is extremely important. I think trust between us, general cultural fit between the two organizations, limited overlap in terms of people. That's the second big leg of it. And then from the third aspect of this is that if you look at it from IDFC Bank shareholders' point of view, they will end up owning 72% of the combined entity. We believe that the control premium that this transaction entails is actually quite modest relative to recent transactions. Kotak paid 21.5% control premium for the transaction they did. This is much more modest than that. And from a regulatory perspective, remember that IDFC shareholders are obliged to reduce their shareholding in the bank from 54 to 40% by October 2018. So timing of this is really quite crucial because there's no sense in our raising primary capital between now and then. It would have meant that IDFC shareholders would have had to shed stock in the market. That would have not been constructive for the share price, and therefore this is a very elegant way for IDFC to also meet its regulatory obligations. So on multiple fronts, this just seems to make sense.
Absolutely. Mr. Vaidyanathan, now, Dr. Lall has spoken publicly about, the need to expand retail base of the bank. He's spoken about, inorganic being an optional route, perhaps a preferred route. In your case, I know at the back of your mind there may have been that desire to be a bank, but you were growing very well. As an NBFC, you've had a very, very strong, sort of growth path. Why did you feel the need to do this right now? You could have potentially waited until your book was, 50,000 crore or more than that.
Probably more.
Yeah.
So when we started, we had a loan book of just about 94 crores in retail.
Yeah.
So we felt that growing from there to about 25,000 crores. In the initial stage, when our book was growing from 20 to maybe 15 or 16,000 crores, there was real funding challenges because we were small NBFC. In the last 3 years, those funding challenges have vanished because companies become large. Now, from here to about 60, 70,000 crore, of course, we could have pulled staying in NBFC. Life would have been fine. But at some stage, if we got to make an eternal organization, then we have to be a bank because the liability base has to be diversified and has to be stable. It doesn't matter it's low cost. Of course, it's a big bonus, but it has to be more diversified than being low cost. So that was a key need. So that need could have waited 5 years. But then it doesn't mean that at the end of 5th year, I got a great opportunity like this sitting on me. So sometimes, a good relationship comes by, they strike it, don't really wait for the best timing.
Okay, since you've gotten into the liabilities conversation, let me get straight into that. Dr. Lall, I asked you this at the last, merger time as well. Should the liabilities base not come before the asset base? You said that it should be reverse.
Yeah,
but I mean,
let me reiterate the argument. That how do you, aggregating liabilities is a long-term task. It takes time to do it. It's a marathon business. He incidentally is a marathon runner. But jokes aside, it takes time. It cannot be done overnight. How do you acquire liabilities? You acquire liabilities, you can do it independently of assets, but from a customer point of view, they want a holistic relationship with whoever's their bank. So the strategic bet calculus that we're making is that the resources required to actually build that liabilities franchise will be generated by retailizing the balance sheet. Acquiring the customers to whom you can cross-sell liabilities, develop a more wholesome relationship with them, a more long-lasting one, at an accelerated pace. That's been our view. Just theoretically, as a counterfactual, acquire a liabilities base. What does that mean? It means a bank. Now, banks are not just hanging off trees that we can go pick one and say, yeah, this is great, give me my liabilities.
Quite a few banks, but I'll come to that later.
No, so let's not delve too deeply into that. You know what I'm saying. Culture, chemistry, people, there's so many other things involved in making an M&A transaction work. As Vaidya said, relationships don't come by that easily, and we learn by experience. This one we grabbed.
There were a few hanging on the tree actually at the point of time.
What was hanging on the tree? Potential opposite.
There were a few banks hanging
for you or for him?
For us, and we were looking here and there, but then at the back of our mind, we never said it. I said it publicly also that we want to be a bank.
You did.
I did, and it's been maybe since 3 years I've been saying it without being shy. No, I'm fine as an NBFC. I can pull on forever. I never took that line. I said I want to be a bank. Now, there were some there in the horizon. And
banks, huh? You want to name any of them? Now that the deal is done, I'm happy to hear.
I'll hold it for another day. But they were there, and thinking about talking to them, or even talk to some of those, key shareholders. But then when this proposition came along between the two of us, I felt this is a very good fit because this is a very good bank. It's got very good people, it's got a very good culture, it's got a banking license, it's got a 2-year head start. I really like this bank. So when you put that and then you say, okay, we've got capabilities, they've got the banking license, put them together and we have a bank. And the key idea is to say, it's just not about adding value to capital for shareholders. It's not the objective alone. How to add value to IDFC Bank shareholders. And I think we can really bring a lot of value when we put the pieces together and grow the bank together over the next 10 years.
Okay, so tell me your perspective on this liabilities issue. I mean, you headed retail at ICICI Bank. That was a different era. Since then, the market has become more and more crowded. The guys you're going to go and lend to are all banked customers, right? So how do you then convince them to become deposit customers? The interest rate lever has worked in part for some of the smaller banks, but it's not like there has been large-scale migration of deposits away from public sector banks or the guys who offer 3.5%. It hasn't happened.
Fair enough. But just think about what is getting created in India. And that is the most important thing. End of the day, even in the formal organized sector, India is creating jobs. Over the next 10 years, India will create that many more jobs. Over the next 10 years, Indian economy will be $7 trillion. Now, that amount of GDP is yet to be created. There will be jobs, there will be people. So I have to just play.
But that GDP has to come to you, into your...
Absolutely fair question. But there is no reason why the GDP will not come to us. If we have a proposition and we have a branch network and we have something for the customer and we cross-sell and we give a bouquet, why not? IDFC is a good brand, Capital First is a good brand, and when the two brands come together, there is an opportunity of the new. I'm not even talking about how many of our lending customers will convert to liability customers. There is an opportunity there, but we haven't quantified it. But let's talk about the bigger picture of what is to come. If you think about it like this, if you think about the fact that, look, an ICICI bank is 40%, HDFC bank is 40%, where will you start? No new bank can ever get started.
No, I agree. You have to start somewhere, but I'm just saying that the market is very different from what it was 10 years back.
No bank, so everybody has to start somewhere. And that somewhere is now. And this is not the last bank. There will be 40 more banks that will come, and for them, they will be an upstart, and we'll probably be on our path.
Just to reinforce the point, I mean, you made the point earlier, which I think is a very good one, that you look at some of the smaller banks that are out there, they're still growing their liabilities base by 20-30% a year. Okay.
How are they doing it?
You just take us as an IDFC bank. Our CASA was 3,200 odd last quarter. Our target for this quarter is well over 4,000 crores. You'll see when our quarterly numbers are announced. We've got traction. Okay. With a very incipient branch network. Now you just imagine 3 million additional customers, total customer base of 5 million, much higher earning power, much wider distribution network. This will gain traction.
This will. So, you know, the issues really to worry about is not how will we get liabilities, how will we, okay, fine, the challenge, we've got to deal with it. Who doesn't have challenges? The issue to deal with, the picture is bigger than that. The picture is, okay, let's take a 10-year story and let us see how will the fairway play out, how will the opportunity play out, and how can we take advantage of that opportunity given the strengths we already have. That's where our mind is.
Will you still, now as a combined entity, continue to want to grow inorganically to gain size?
No, the answer is focus, focus, focus. No distractions.
That's not an answer, Mr. Vaidyanathan.
Genuinely, you've got to focus. That really is a focus right now.
But focus on what? Inorganic opportunities or organic growth?
No.
First make this work, no?
First make this work.
Okay.
Step by step.
Because if you play 2-3 things at the same time, you'll just get confused. Because, you know, this process is going to take 9 months for information, 6 to 9 months for the shareholders to come through. I don't want to confuse the shareholders with one more storyline even before.
No, actually, the reason I asked that on a serious note is that I'm wondering whether in this current banking market to achieve scale, I mean, if I have my numbers right, I think you're 7th on the pecking, or 7th or some thereabouts on the pecking order among private banks. So if you want to move up, my question is genuine. Is it only going to happen inorganically, that move up from say 7 to 4 to 5 or 3?
Yeah, I answered that question already. I'm saying I'm not so fussed with the 7th or 8th or 9th or 6th. Really, that will keep changing in lives and let them all grow, and we'll also grow. I am not here in that competition. The story is about that we have something on hand to do. There are employees to bring together into a larger platform. There are shareholders. There are regulators. There are the courts. There is a job to do. So to think of it, we can't get distracted from the story. No.
Let me ask you. So I mean, just hygiene stuff. So how does the shareholding now end up in the merged entity?
They said IDFC Bank shareholders end up with 72%.
Okay.
Capital First shareholders end up with 28%.
Okay. And Warburg holds how much in the combined entity now?
A little over 10%.
A little over 10%.
Okay. Yeah. So there are no regulatory issues.
No.
So that
I mean, they might have to marginally sell a small percentage. IDFC as the parent apparently have to buy a small percentage anyway to match to become promoter holding of 40%.
To remain at 40%.
Okay. So I think there is some inter-say movement. They may. I can't call it inter-say. They've got to figure it out for themselves. But someone has to sell and someone has to buy. And whether from the market or from each other. And I think it's broadly manageable. Things look to be pretty much sorted out.
Yeah.
Okay. On the lending side, Dr. Lall, so I mean now a diversified portfolio, right? So you've got large corporate infrastructure, SME, very interesting SME book, retail, full suite more or less?
No, whatever Vaidya wants to build on top of this. Yeah, but for now, full suite. I mean, full suite is not the right answer. Our stated goal was diversification. We will have achieved that. Very sound foundation on which to build the future.
I think Dr. Lall's phenomenal achievement is to find someone who has it, who has this machine, and give his shareholders a patch of this, combine it all. I think that's really a big contribution. Like I said before, to put the platform together for a banking license is his very big contribution. To give it a head start over the last 2 years is his big contribution. As far as what we are thinking forward into this storyline, retail is going to be a very big play for us. It's too important. I have no...
So what, 50% of the book?
Probably more.
More.
Because retail is very important, because we believe retail does three significant things. One, it brings diversification, which is key. Number two, it brings relationships, because you can sell a lot more to that base. And thirdly, it's far more stable in asset quality. It's not black swanish. So to me, retail is very important. Does that mean wholesale infrastructure is not important? By no means. It's very important. We want to do it. But we've got to figure out how we're going to do it in a way where it is as less volatile in terms of credit quality. The key thing is, how do we manage a bank or keep a bank where credit quality is stable and gives us peace of mind? That's
but retail also goes through accidents, Mr. Vaidyanathan. You've gone through one at ICICI.
No,
I mean, and there's been some concern even raised by regulators that retail is growing too rapidly right now.
Absolutely. No, it is absolutely the regulator's job to keep a macro eye on the overall picture and see which way the economy is shaping. But if you see the Indian retail system starting from the 1970s, when HDFC must have started its first few home loans, and 35 years or 40 years since in 2018, you will see the retail has been this most stable piece of the Indian financial services book. The wholesale book has gone through many ups and downs, and you've seen the latest one for the last 5 years. But retail, tell me one lender, whether it's ICICI, HDFC Bank, Kotak Mahindra Bank, name one bank where they've had a home loan problem in the last 20 years. Not one has a home loan had a problem, not one.
Home loan is a very specific segment, especially urban home loan. Now, rural housing is giving you a completely different experience.
We'll come to that. And that's a big piece. Home loans about 50% of Indian lending GDP, 50%. We talk about car loans. It's been 35 years. Not a single lender has taken a bloodbath in car loan business, and that's about 15% of the loan book. Then you talk of commercial vehicle financing. Then you talk of personal credit. Now let's talk about personal credit. Personal credit, it is small. The salaried personal credit till today in 25 years has not taken a bloodbath, not even in 2008 when the economic crisis was there. The salaried employees of Infosys and Wipro and all banks were all paying pretty well. So therefore, it is a small ticket financing of, if you run a large piece, one ticket somewhere can always have a problem. You live and learn. But I think retail has been it's the most, statistically speaking, if you go back to the bar curves, retail is the most stable book you can build.
I just wanted to add to that, Vaidya, is that, see, diversification is key. You can't be, and it's much easier, and it's a more granular business, and therefore it is possible to build a diversified book in retail. You don't have the same type of concentration risk that you have in wholesale. The crises, the 1997 crises, ICICI, all our institutions faced, and the more recent one in
2008-9,
all wholesale.
All wholesale. And retail, if you take 10 products and one of them had a problem for 1 year, it's a big deal. But the big issue that the home loans in car loans, which is about 90% of the Indian loan book, never had a problem. So I'd say retail is very safe. Now that doesn't mean that all wholesale is all a can of worms. That's not true. It's a phase. But I think people live and learn with the phase.
No, but both of you are sounding very, are you sounding cautious on project financing, which was,
my God, I'll answer that question.
No, you're not going to do project financing in the next phase.
Who knows where we'll do it in the next phase or not, where they will decide that. But I can tell you that the infrastructure story, because in this country, private infrastructure financing, my conclusion from all these years of having done it is that institutionally, in this country, we were not prepared. it's going to be very hard. So look at the nature of, just to switch to macro, this is important.
Yes, absolutely.
The nature of the investment upcycle now is very different from the investment upcycle, up 2009, 10, all of that. That was driven by large ticket infrastructure. This is based on capacity utilization, customer facing, consumer facing.
Yes.
So this is the future for the economy. That was an aberration. And there's a reason why government today is taking the lead on infrastructure building and financing. I think the paradigm for how infrastructure gets funded in this country will change. But that's a different conversation. Let's not distract from
it is a different conversation, but you're an organization with a project financing DNA.
Yeah.
And you're saying...
So, Ira, please, there are 100 people out of 3,000, 4,000 people in IDFC Bank that have project finance, okay? So let's not...
But that won't be a big chunk in, say, the next 5 years, you think?
Like I said, I got to think about it. But I'll tell you one thing, that even in, let me say, corporate financing is going to be an important piece of India for the next 10 years, because India is now back on an upswing. Let us not forget that. That's an opportunity. End of the day, around an infrastructure that comes up, there are jobs that are getting created, and there's an ecosystem getting created, and we cannot be oblivious of the whole piece. But I must say that if I give you a straight answer, what gives me peace of mind? Retail gives me peace of mind. Is it because I've done it 27 years of my life and I have a bias for it? Probably yes. But I've seen cycles around, and I can say that this gives peace of mind. And as I can tell you, as a key management, as a shareholder, what do you want? You want peace of mind. At the same time, they will all grow India, and both pieces are required to be. Someone's got to produce, you've got to finance that, and someone's got to consume, you've got to finance that. So I think, I don't think we should completely split the two and make a big story out of this. It is basically the whole composite piece will create value.
Okay. And in this retail financing sort of, since a lot of private banks are focused, by private, even public are focused.
About this whole infrastructure financing?
No,
that's
talk to the PhD of extra infrastructure.
He's just shot me down saying that's a different conversation for a different time.
He's the PhD, he is the ultimate PhD in infrastructure.
But I could, just to, this is germane to this conversation, you look at the banks that have sustainably created value over the last 15 years through the cycle. They are banks that have eschewed very big ticket financing for corporates. It's not that they don't do it, but the proportion is quite different. That the market is sophisticated, they understand.
I get that, but then everybody is doing the same, then how do you guys differentiate?
But everybody doing the same now. You know what the numbers are. I keep repeating this ad nauseum. Till today, even until last quarter, I'll go back and do the numbers now. 45% of all bank lending in this country is only to 300 corporates.
No, I meant retail. I meant if retail
when you say
is the
everybody's
focus.
Doing it, when you say 45%.
No, I'm talking about retail. Everybody's doing retail. The PSUs are doing retail.
The private
corporate
also.
So I'm saying, is there a is there a need for a differentiator? If so, then what is your differentiator?
So I'll set him up for that. I'll set him up for that. I'm expecting Vaidya, no pressure. I'm expecting Vaidya to build a bank like no other.
Okay then, and how's that going to happen?
Absolutely. He is looking at me building a bank like no other. I'm looking at a bank that will give me peace of mind. A bank that will grow maybe between 15 to 20% per year continuously for a long period of time. A bank that can increase its return on equity from say a 5% to a 15%. A bank that can operate in certain areas which have intellectual property created to it. This is the kind of bank I am looking at. If we can create a bank like that, I think there's tremendous value to be created. He once told me he's going to keep all his stock options and all his wealth in IDFC.
Yeah. He's my wealth manager.
Really?
Yeah.
How do I confirm that now?
Because he's going to keep his stock with me. So all I'm saying, and I've got my own stock in IDFC. So the IDFC bank, the new merged bank, whatever we're going to call it eventually. So we are all interested parties in building a long-term stable bank. And I can tell you, my key focus actually building an institution that can last decades and centuries.
An institution which is going to be at least more than half retail and will continue to grow at 15 to 20%. Those are the snippets of various comments.
I said more than that.
More than 50%. I'm taking the conservative end.
I think you're understating the 50%. At least the way I'm thinking about it, I'm thinking of, I haven't put a numbers, we haven't worked out.
60%, 75% retail.
Pick a number, but it's going to be very, very large.
Yeah. Which is what we've also stated we want to do.
Pick a number that's very, very large.
But that would be the largest, I mean, that would be the largest skew towards retail.
Again,
largest skew towards retail, right? What is HDFC Bank?
I'll come to that. That's precisely what I'm trying to get against that, right? I'm not here to compare what other banks are doing.
No, neither am I.
Exactly.
So but I'm just doing benchmarking.
I don't want benchmarking. All I'm saying is that we are doing what we believe in. We believe that retail is relationships, retail is granular, and we want to do retail. Now, and that's and actually, finances the market which has traditionally in India not been financed, like you said. So everybody, the 300 corporates have grabbed maybe 40-50% of the country's credit. So we were somewhere else. But to your question, don't put a benchmark of 50. It could be higher.
It could be higher. And retail, you're including SME here, right? In
small SME.
Very small SME.
Not the 40 crore loan SME. I mean the 1 crore and the 50 lakhs or 20 lakhs SME. At least tiny people.
Okay. Just last two questions. One is, sir, on the whole sort of rural finance segment, the Bharat banking, as you had called it when you started out. Is that still part of the game plan? If so, what's the story there?
We've got to figure this out because he's done a wonderful job. To be very honest, I have great admiration for him to how he conceptualized this from a piece of paper and he brought it where he's brought. We've got to think about it deeply and figure out what is the extent of proportion we want from Bharat, what we want from Bharat Plus. But he's absolutely right in the way he's framed it, that both of these pieces are extremely important for the growth of the organization. I'm not putting a finger on it on which button I want to press, but certainly I have to say that the strategy of heading tier 1, 2, 3, 4 village is absolutely right.
Dr. You're still convinced it can happen?
So, yeah, of course it can happen because technology, processes, all that are becoming more and more efficient. This is a theme. Regulatory changes have made it easier to service lower ticket customers much more effectively operationally than before, at lower cost than before. That's one important theme. The other important theme is by regulation, for compliance reasons, banks have to meet their priority sector lending criteria, and in that the subcategory for rural and aggregate lending is a challenging one to meet. So here the challenge for a new age bank is how to do that in a manner that's not just a compliance checks the box. Let's do it in a manner that actually makes business sense.
Absolutely right.
Okay. Since you brought that up, sorry, I forgot this earlier. You need to raise more capital for CRR SLR?
No. For CRR SLR, we need 6,000 crores, of which 2,000 we already have excess, so we need to raise 4,000 crores.
Okay, so that will happen some point over the next 9 months or so.
Yeah.
Okay, last question. This sort of I've touched on it earlier, but I want a wider view as well. Both of you are convinced that the banking landscape in India is not overcrowded, and I support my question by saying that since we've gone on tap on licenses, nobody except for I think UAE Exchange or somebody has applied that.
Okay, let me answer that.
Yeah.
Both of you. I want both of your views.
I'll add my view.
No, if you go first, you go first.
No, go.
Okay, I'm just saying that, like they say, what's coming in the long run, I don't mean long run like centuries, I'm talking of 10 years, is so big our eyes are not able to see it today. It's that big. Now, existing banks, not even the emergence of new banks like, Capital First, IDFC Bank, these banks are enough to cater to the needs of India. Not even the big boys, not even the state-owned banks, not even the new banks, not even the 10 new licenses come. My personal assessment is that we need maybe 30 more banks coming up soon.
Universal banks, not differentiated
maybe universal or small finance, whichever category you put it, or even payment bank. But you will need that money to really cater to the needs of India. We are just at the start of it, which is why it gives me the confidence that we are never too late. It's a marathon, but never too late to start a marathon.
I'll add one thing, which is that no matter how crowded the market may seem, quite apart from the macro opportunity, there's always room for a good quality enterprise. That's what we built.
And what is it going to be called? Sorry.
So we had conversations about that. There are very interesting possibilities to refresh our positioning. Stay tuned.
So you are going to refresh the branding?
Why not?
We talked about
Absolutely.
it, just to
Makes
be
sense.
straight, just for you and for viewers, and just to be honest with each other and everybody, we talked about it as one of the key things we talked about.
Okay.
So we said, look, Capital First is a good consumer brand, people know it. IDFC is, of course, an iconic brand. So we said, how are we going to bring it all together?
Best together.
So whether, you saw speculation in one of the newspapers today, whether you're going to get the first IDFC Bank, or you're going to call it IDFC First Bank. So, but you tune it and figure it out where you're going to get there.
Okay, we'll wait to hear on that. But thank you so much.
Okay.
It was a lovely conversation. Thank you.
Thank you. Thank you.
Bye.
Good.